So you're 45 or 52 or maybe even 63, and you've been thinking about property investment for years. But there's a little voice in your head that says, I'm a little too old. I've missed the window. Banks won't lend to me. I can't possibly build a portfolio before retirement. Here's what's actually true and what's complete fiction, because I'm about to show you the exact strategy banks use to decide whether they'll lend to older investors. And spoiler alert, it's not what you think. And if you're seriously considering property investment in your 40s, 50s, or even 60s, the decision you make in the next 10 minutes could literally change your retirement. So let's go. By the end of this video, I'm going to show you 3 completely different property investment strategies. One for your 40s, one for your 50s, and one for your 60s. And they're not the same playbook you hear for 25-year-olds. I'm also going to reveal the one decision that most older investors get completely wrong, and it costs them hundreds of thousands of dollars in retirement income. And I'm going to introduce you to a financial tool that basically lets you unlock your home equity without selling, which sounds too good to be true, but it's absolutely real, and most people don't even know that it exists. So I want you to stick with me. So let me start by addressing the thing that stops more potential property investors than anything else: the belief that you are too old. Maybe you're 44, maybe you're 56, maybe you're 61, and you've been watching property prices climb, watching other people build portfolios and thinking, I've missed it. I should have started 10 years ago. It's too late now. That belief is ruining your retirement, and I say that with genuine care, because the truth is this: property investing in your late 40s, your 50s, or your 60s is not just possible, it's often smarter than doing it earlier. And if you understand the actual rules, the numbers that banks use, you'll realize you're probably in a stronger position than you think. So let me be direct here. The banking system is not ageist. Banks don't care how old you are. What they care about is whether you can service the debt and whether you'll be around long enough to pay it back. And here's what most people don't realize. The older you get, especially in your 50s and 60s, the more the lender knows about your stability. You've got a track record, you've got assets, you've proven you can manage your money. Compare that to a 25-year-old with no track record, $30,000 in student loans, and 0 assets. Who's the lower risk borrower? And it's usually the 55-year-old. So let me demolish the age myth right now, because it's built on 3 false assumptions. False assumption number 1, you need to have the mortgage paid off before retirement. This is the biggest one. People think if I buy property now, I'll be 70 when the mortgage matures, and that's terrible. But here's the reality. Most Australians work into their mid-60s, many work into their 70s. The retirement age officially is 67 right now, and it's rising. So the idea that you must have a mortgage paid off by 65 is completely outdated. Very, very outdated. In fact, you can get a 30-year loan at age 50 that matures when you're 80. And if you're drawing rental income from the property during that period, if the property is positively geared and paying for itself, you're actually in an excellent position. You've got an asset that's appreciating in value, generating income, and you might not even be in financial stress. Most lenders understand this. That's why banks are still handing out 25 to 30-year loan terms to people in their 50s. False assumption number 2, banks won't lend to older borrowers. This one is partially true and partially false, which makes it dangerous. If you're 65 and you come to a bank saying, I just retired, I have no income, and I want to borrow $500,000, then yes, you're most likely going to be declined. So that's just fair risk management right there. But if you're 65 and you have ongoing income because you're still working part-time, or you've got rental income already, or you're drawing a super pension, or you've got multiple income streams, then the conversation is completely different. Banks will absolutely lend to you. In fact, if anything, a 65-year-old with proven income and assets is lower risk than a 35-year-old with unstable income and no financial history. The real constraint isn't age, it's income and assets. And older borrowers usually have both. False assumption number 3, I can't build meaningful wealth in my last 10 years of work. This is the one that hurts most because it's the most obviously wrong when you look at the numbers. Let's say you're 50 years old. You've got 15 years until the traditional retirement age of 65. And realistically, you might work to 70. So you've got 15 to 20 years of income earning years left. If you buy just one investment property in your early 50s, and that property appreciates by even a conservative 4% per year, which is below the long-term Australian averages, a $600,000 property becomes worth about $1.04 million in 15 years' time. Buy 2 properties, you're now looking at $2.08 million in assets. And that's without any active value add or renovations. That's just holding and letting the market work. Now, add in the fact that you're paying down the mortgage at the same time. Over 15 years, you might reduce the loan from $500,000 to $300,000. So your net equity in 2 properties could be $1.9 million by the time you retire. That's not insignificant. That's a meaningful nest egg right there. And if those properties are positively geared, meaning the rent covers the mortgage, taxes, insurance, and maintenance, you're already generating monthly income to live on in retirement. So the age myth is exactly that. It's a myth. It's not about whether you're too old. It's about whether you understand the actual mechanics of how property wealth is built at different life stages. Which brings us to the real framework, because investing at 40 is not the same as investing at 50, which is not the same as investing in 60. Each age has its own distinct strategy. So let me start with the 40s, because if you're in this decade of your life, you've got something most people would kill for, and that's time. At 40, you've got roughly 20 to 25 years until traditional retirement age. That's a long runway. And more importantly, you're usually or approaching your peak earning years. Most professionals in their 40s have established themselves in their careers. They've got decent income. They've got a track record that banks trust. So here's the 40s property investment playbook. First, build for growth, not income. In your 40s, your advantage is time to compound. That means you want growth properties, not necessarily cash flowing properties. You want to buy well-located suburban or regional properties in strong growth markets. You're getting better. You're betting on the market doing the work for you over the next 15 to 20 years. Properties in Sydney, Melbourne, Brisbane, the major growth metros make sense. You're not worried if the property is negatively geared by $100 or even $200 a month, because you've got income from your job to cover it. And the property appreciation will make up for it many, many, many times over. Second, use leveraging aggressively, but responsibly. You can afford to borrow 80, 85, even 90% of the property's value because you've got the income. Your debt to income ratio at 40, if you're a professional earning good money, is usually quite reasonable. The new APRA lending rules, which cap high DTI lending to 20% of banks' new mortgages, these rules affect you less in your 40s because you typically have lower DTI than older investors. This means you can move faster. You can build a portfolio of 3, 4, even 5 properties in your 40s if you've got the income and you're strategic about it. Here's a concrete example, right? So let's say you earn $120,000 per year. You own your family home valued at $800,000 with a $500,000 mortgage. You've built $300,000 in equity. You could theoretically pull out $200,000 of that equity via refinance and use it to buy an investment property. You'd be investing $200,000 into a property, probably needing to add another $50,000 from savings, borrowing $550,000. So your total debt now is $500,000 for the home plus $550,000 for the investment, which is about $1.05 million. Your DTI, debt to income ratio, is 8.75x. That's pretty high. But in your 40s with stable income, most banks will still lend to you, or at least lend you up to 80%. That's within standard parameters. You've just deployed $250,000 of your own capital and leveraged it into an $800,000 worth of property assets. And in 15 years, if that property appreciates 4% annually, it's now worth $1.44 million. Your equity position has grown from $250,000 invested to $890,000 of net equity, assuming you paid down your own mortgage. That's a 3.5-fold return just from time and market appreciation. Now, multiply that across 2, 3, or 4 properties, and you can start to see why the 40s are actually the most powerful decade for property wealth building. Third, don't get distracted by tax benefits. I know a lot of property educators talk about negative gearing and tax deductions, and yes, those are real benefits. But in your 40s, your primary goal should be capital growth, not tax minimization. You're still earning good income from your job. You're in your peak earning decade. That income to fund properties that are growth focused and let the tax benefits be a secondary consideration. The money you save in tax, maybe $5,000 to $10,000 a year, is nice, but the capital growth from 4% appreciation per year for $600,000 is $24,000 a year. That's your real wealth builder right there. So the 40s strategy is simple. Time plus leverage plus growth equals meaningful wealth building. You're not trying to break even on cash flow. You're trying to accumulate assets that will be paid down and appreciating when you hit retirement. Now, the 50s. This is where things shift a little. At 50, you've got about 15 years of traditional retirement, less time than your 40s, but still meaningful. And here's what changes. You're not thinking about time anymore. You're thinking about strategy. In your 50s, you need a clear plan. And that plan needs to balance growth with income generation. You're starting to think about the fact that in 15 years, you want assets that are working for you, not assets that are still costing you money every single month. So the 50 strategy has to have a different focus. First, quality over quantity. Instead of building a portfolio of 5 properties like you might do in your 40s, in your 50s, you're building 2 to 3 excellent properties, maximum. You're a lot more selective. You're thinking about suburbs with strong rental demand. You're thinking about properties that will appreciate and also generate reasonable cash flow. You're not buying a negative geared apartment hoping it appreciates. You're buying solid house in growth suburbs that will appreciate and produce decent rental income. Secondly, manufactured growth through renovations. This is the 50s edge. You've got time, but not unlimited time. So you can't just rely on market appreciation. You need to manufacture some of that growth yourself. This means buying properties that need modest improvements, doing smart renovations and either holding them or selling them post-renovation. You're not doing major, risky developments. You're doing tactical improvements that add genuine value. A 20-year-old home in a good suburb, renovated kitchen and bathrooms, fresh paint and landscaping, you can add 10 to 15% to the property value. That's $60,000 to $90,000 on a $600,000 property. You've manufactured that growth in 6 to 12 months rather than waiting 5 years for the market. And here's why this matters. In your 50s, time is starting to matter. If you rely purely on market appreciation, you're hoping the market cooperates. If you manufacture growth through smart improvements, you control the timeline. Third, start positioning for retirement income. This is the 50s shifts. You're not just building for growth. You're starting to think about, in 10 years, I want properties that generate income. This means your property selection in your 50s should lean towards stronger rental yields. Instead of buying purely growth plays, you're looking for properties that have solid 4 to 5% gross rental yields. That's a bit lower growth potential, but it means that by the time you retire, these properties are generating $500, $600, $700 a month in net rental income for you. That's the foundation of your rental income. Let me give you a concrete example here. So you're 52. You go ahead and buy a duplex in a strong rental market like Brisbane for $800,000. You put down a 20% or $160,000. Borrow the remainder of $640,000. It rents out for $2,100 per week combined, or about $109,000 per year. After mortgage interests, rates, insurance, maintenance, vacancy, you've got about $15,000 per year in net positive cash flow. That's $288 per week surplus. Is that a huge amount? No. But in your 50s, building 2 to 3 properties like that means by the time you retire at 65, you've got $450 to $600 a week of rental income from your investments alone. That combined with super and maybe part-time income is a real retirement plan. So the 50 strategy is about being more thoughtful. You've got less time. You need the strategy. You're manufacturing growth through improvements and you're positioning income generating assets for retirement. And now we get to 60 and beyond. This is where the conversation fundamentally changes. Most people think once you hit 60, property investment is basically off the table. Lenders become conservative. Mortgages are hard to get. You've missed your window. And this is wrong. Absolutely, completely wrong. And the misconception is costing people hundreds of thousands of dollars in retirement income. So here's the truth. At 60, you have an advantage that 40-year-olds don't have. You have existing equity. If you've been living in your family home for 30 years and paid down the mortgage, you might have $600, $800, or $1 million in equity locked away in your primary residence. That's capital. That's real, tangible capital that can be deployed. And here are multiple ways to deploy it without selling your home or cashing in your financial security. Strategy 1, the equity release model. Unlock capital without selling. This is the move that most people don't know about, and it's genuinely powerful. At 60, you can access what's called a reverse mortgage. And here's how it works. You own a home worth, let's say, $1 million. You've got it mostly paid off, if not all of it. You can go to the bank and say, I want to borrow money using my home as security. At age 60, the bank will typically let you borrow 15 to 20% of the home's value. So on a $1 million home, that's $150,000 to $200,000. Here's the beautiful part. You don't make monthly repayments. The loan and interest are repaid when you eventually sell the home, move into aged care, or pass away. In the meantime, you've got $150,000 to $200,000 in cash to deploy into investment properties. If you need more capital later, let's say at 65, you can borrow another $50,000 to $75,000, adding 1% per year over 60. So at 65, you could borrow 20 to 25% of your home's value. The magic of this is you're unlocking your home equity without selling, without disrupting your life, and without making any monthly payments on the borrowed amount. You take that $150,000 to $200,000 and invest it into a property. If that property generates positive cash flow, rent covers mortgage plus all expenses, then the property itself is funding the investment. You're not drawing from your super or your retirement income. The property is self-sustaining. Let me show you a real scenario here. So you're 60, your home is worth $1 million, completely paid off. You use a reverse mortgage to access $180,000. You invest that into a property for $900,000 total, adding a $720,000 mortgage. The property rents for $1,800 per week. After all expenses, the mortgage payments, you've got $150 per week in positive cash flow. That's around $7,800 per year. It's not huge, but it is income that you didn't have before, generated from capital that you already own. And the property itself is appreciating, and you still own your family home. Strategy 2, the downsizing model. Release trapped capital. The second 60 plus strategy is downsizing. Maybe you've got a family home worth $1.2 million, but you don't need a 4-bedroom place anymore. The kids have moved out. You sell the home and buy a smaller property for $600,000 and release these other $600,000 in capital. You invest that $600,000 into rental properties. You've reduced your housing cost dramatically, maybe from a $2,000 mortgage to $1,000, or even paying off the smaller place outright. And you've got $600,000 to deploy into investment properties that generate income. This is particularly powerful if you can downsize to a place that's positively geared or neutral. You own it or have minimal debt, and your living costs drop. Meanwhile, your investment properties are generating income for you. And then the strategy number 3, the SMSF model, which is tax efficient investing through super. The third strategy is a lot more complex, but important for people with significant assets. If you have a self-managed super fund or SMSF, you can use that fund to purchase investment properties. Here's why that's powerful. When a property is held inside super, the rental income is taxed at a maximum rate of 15% while you work. When you retire and access it as an income stream, the earnings are taxed at 0%. That's a massive tax advantage. If you've got $300,000 to $500,000 in super and you use that to buy a property, either outright or with leverage through a loan arrangement, LRBA, you're building retirement income in a tax-effective structure. This does require professional advice, right? Because super has specific rules. So I do advise, I highly recommend you go speak to a financial advisor and an accountant that specializes in the SMSF realm. But for people at 60 plus who understand they need to diversify their retirement income beyond just government super benefits, SMSF property investment is a legitimate strategy. Fourth is focus entirely on income, not growth. Here's the mental shift that matters at 60 plus. Stop thinking about capital appreciation. Start thinking about cash flow. You don't need a property to double in value over the next 20 years. You need a property that generates $300, $400, $500 per month in positive cash flow so that you can live comfortably in retirement. That means you're buying positively geared properties in strong rental markets. Perth, parts of Melbourne, Adelaide, suburbs where rent to price ratios are really good. You're not chasing the hot growth market. You're chasing reliable income. At the $600,000 property, the rent's for $2,200 per month, has a $1,600 in total expenses. So that's mortgage, rates, insurance, maintenance, vacancy, giving you $600 per month surplus. That's $7,200 per year in passive income from that one property. So 2 of those properties, you're talking $14,400 per year. 3, $21,600 per year. That's money you can slowly start to live on. Now, let's address the elephant in the room because a lot of people are worried about this. Will banks even lend to me when I'm 60 or 65? And the honest answer is, it depends. And here's the breakdown. At age 55, most lenders start to ask questions. They want evidence of your superannuation, evidence that you've got assets that can be sold to repay the debt. But they're not refusing outright. They just want to know your exit strategy. At age 60, this is where it starts to get a lot tighter. Most banks will be hesitant to lend on you based on employment income alone if you've already retired. If you have ongoing income, so part-time work, business income, rental income from existing properties, early super access, then you're in a much stronger position. At age 65 plus, you're at the point where banks will only lend if you have a very clear, documented income source that extends beyond traditional retirement age. But it's not a hard no. It's a show us your income, and if it's solid, we may lend to you. So here's what banks actually care about. Number one, income. Can you service the debt? If yes, you can borrow. 2, assets. Do you have existing wealth that demonstrates financial stability? Banks absolutely love this because it de-risks the loan. And then 3, your exit strategy. If everything falls apart, how will this get repaid? Older borrowers need to prove that they have an exit route, superannuation, a home they can sell, children who might inherit property, etc. Older borrowers often exceed banks' requirements on number 2 and number 3, which can offset concerns about number 1. So let me give you a practical framework. If you're 60 and you want to borrow $500,000 in investment property, here's what strengthens your application. You have ongoing income, part-time work, rental income, business income, right? You own a home worth $1 million with minimal mortgages. Your investment property is positively geared, so rent covers your expenses. You have significant superannuation or liquid assets you can access quickly. You've documented your ability to service the mortgage with available income. The combination of these factors make you lower risk than a 35-year-old, unstable income, and no assets. Now, there is one wrinkle to be aware of, and this affects particularly older investors right now in 2026. Starting February 1st, 2026, Australia's banking regulator, APRA, put in place a new rule that affects how much banks can lend to high debt borrowers. The rule is this: banks can lend to borrowers with high debt to income ratios, so 6 times income or more, but only to a maximum of 20% of their new lending, to the volumes of people they are lending to. So if a bank normally issues 1,000 new home loans per quarter, they can only lend to 200 of those borrowers if they have high debt to income ratios. And here's why this matters for older investors. Older investors have high DTIs than younger investors because they have more existing debt. They might have multiple mortgages. They might have investment loans. They might have business debt. All of this goes into the DTI calculation. So while the 20% cap affects older investors disproportionately, it's not a deal breaker. It just means you need to apply early before the lender hits the 20% cap for the quarter. You need to be even more rigorous about proving your serviceability. And you might need to shop around for a lender who hasn't hit their cap yet. But it's still possible, it's just more competitive. The key insight here is the new APRA rules makes it slightly harder to qualify if you have a high DTI, but they don't make it impossible. And for older investors with strong existing assets and clear cash flow, you're still an attractive borrower. Now, I want to touch on something that I mentioned at the beginning, because this is the decision that separates people who have great retirements from people who are stressed at retirement. At some point in your 50s or early 60s, you're going to face a choice. Sell down your existing investments and contribute the proceeds to superannuation, or hold them as direct property investments. And this decision is massive. It's worth hundreds of thousands of dollars across your lifetime. So here's the framework. If you sell an investment property and contribute the proceeds to super, you get several benefits. You can claim a tax deduction for the contribution up to $27,500 per year in concessional contributions. All future growth in that super is taxed at a maximum of 15% and 0% in retirement. You're consolidating your wealth in a tax-efficient vehicle, and you've reduced your DTI, which helps future borrowing. So let me give you an example. You're 58, you sell an investment property for $700,000. You've paid $500,000 for it. So you've got around $200,000 in capital gain. Now, normally you'd pay capital gains tax on that, approximately $53,000 to $94,000, depending on your tax bracket. But if you contribute $700,000 to super, or even a portion of it, you can claim a tax deduction, which effectively offsets the capital gains. You might save $50,000 plus in taxes. Now, that $700,000 in super, generating rental income or investment returns that are taxed at only 15% instead of your personal tax rate, which could be 37 to 47%, over 10 years to retirement, that tax difference could be worth $100,000 or more. But here's the counter argument. If you hold that property directly, you own a tangible asset. You can refinance against it to buy more properties. You have the flexibility. And if you're accessing it for more income in retirement, you're choosing how to access that income. The best answer is usually a mix of both. Keep 1 to 2 investment properties directly and contribute proceeds from property sales to super for tax efficiency, right? But the point is, you need to make this decision consciously, not accidentally. Now, all these are obviously examples for general purpose to sort of give you an example of what is possible, but I highly recommend you seek a professional financial advisor that specializes in the SMSF space and an accountant to help you with the tax strategy components, right? But this gives you an overall example on how it could work. Let me show you what actually realistic retirement income looks like from a property investment at different stages. So scenario 1, you start at 40, you build a portfolio of 4 properties by age 55, each valued at approximately $700,000. You've paid down the mortgages to approximately $350,000 each. Total property value, $2.8 million. Total mortgages, $1.4 million. Your total equity is $1.4 million. You retire at 60. You've now got $1.4 million in net property equity. If you use a strategy where you gradually pay down the mortgage and focus on positive cash flow, you might be generating $800 to $1,200 per month in rental income. That's $9,600 to $14,000 per year from property, plus your superannuation pension, plus maybe some part-time income. That's a comfortable retirement income right there. Scenario 2, you start at 50. You build a portfolio of 2 to 3 properties by age 60. Each is focused on positive cash flow and has been refinanced or paid down to a level where it's generating surplus income. You've got approximately $1 million in net equity across all properties. You retire at 65, you're generating $400, $600 per month in rental income. That's $4,800 to $7,200 per year, plus super, plus part-time income you choose to take. That's a modest but respectable retirement income foundation. Plus, you still own the property assets, which you can sell later on. Scenario 3, you start at 60. You use equity release from your home to invest $200,000 into a rental property. You've got a modest mortgage on that property. You retire at 65. That property is generating $200 to $300 per month in positive cash flow. That's $2,400 to $3,600 per year from property income, plus your full superannuation pension, which is your main source of income. Notice what I'm describing here? I'm not talking about becoming a multi-millionaire through property investing starting at 60. I'm talking about using your existing assets strategically to generate modest but meaningful additional income in retirement. And that's the real value of late-stage property investing. It's not about building an empire. It's about using your accumulated equity to fund a better retirement. Now, before we wrap up, I want to warn you about one huge mistake that older investors make. They see property prices climbing. They see investment gurus talking about capital appreciation, and they make the same investment decisions as a 40-year-old would. They buy a property in a hot market, hot growth market, Sydney, parts of Melbourne, hoping for 8, 10, 12% annual appreciation. The property is negatively geared by $100, $200 per month, sometimes even per week. They're drawing money from super to cover the shortfall. And they tell themselves, it's fine, it'll appreciate. But here's the problem. If you're 60 and you need the investment to work for you in the next 5 to 10 years, not 20 years, then you can't afford to wait for capital appreciation. You need cash flow now. A negatively geared property at 60 is not an investment. It's a liability. You're drawing down your retirement capital to fund an investment that's not paying for itself. The decision at 60 is completely different from the decision at 40. At 40, you've got time. At 60, you've got cash flow needs. So here's the rule. At 40 and beyond, buying properties that are positively geared or cash flow neutral, full stop. If the property doesn't cover its own expenses from day one, don't buy it. Wait for one that does. This is the mental shift that separates successful late-stage investors from people who are still struggling at 65 because they made growth-focused decisions at 60. So let me wrap all this up because I want to be crystal clear on the actual answer to the question. Is it too late to start property investing at my age? If you're in your 40s, no, it's not too late. It's actually the ideal time. You've got time, income, and can still grow aggressively. Build for growth. You're at your advantage. If you're in your 50s, no, it's not too late. You've got 15 years, which is meaningful. Shift to a strategy that balances growth with income generation. Be clear and deliberate. You can build 2 to 3 solid properties that work for you. And if you're in your 60s, it's also not too late. You've got a completely different playbook, right? Focus on unlocking existing equity and deploying it strategically into income generating assets. You already built the capital. Now I want you to use it. You can be generating additional retirement income by your late 60s. The only way it's too late is if you tell yourself the story that it's too late and let that belief paralyze you. The actual mechanics of property investing, so mortgage terms, lender requirements, strategies at work, these all absolutely work for people in their 40s, 50s, and 60s. What doesn't work is age-based paralysis, the only thing that is stopping you. So here's what I want you to do right now. Stop telling yourself you've missed the window. Stop accepting the belief that you're too old. Instead, identify which decade you're in, 40s, 50s, or 60s, and commit to the strategy for that decade. The 40 strategy is not the 50 strategy. The 50 strategy is not the 60 strategy. Get that right. The age becomes an advantage, not a disadvantage. If this video challenged the assumptions you've been carrying about age and property investing, I want you to hit the like button and leave a comment below. Tell me which age decade applies to you and what was the biggest misconception this video cleared up for you. And if you're serious about building property wealth strategies, at whatever stage you're at, subscribe to the channel. I release new property investment strategies every single week. Not the get rich quick stuff, but the actual frameworks that work for Australian investors across different life stages. Thank you for watching.